Introduction.
We'll do the introduction. Okay, Maria. Okay, so hi, hello. Good morning, good afternoon, good evening, depending where you are on the globe today. And welcome to today's webinar, where we're delighted to once again be working in conjunction with the CME Group. So I'm Nick Spencer-Skeen, the SEO APM Capital. We're a leading financial broker located and regulated in Abu Dhabi. So at APM Capital, we specialize in providing trade execution services to our valued clients, whether they're retail, professional, institutional, both in the exchange traded markets and OTC markets. And as a regulated financial institution, we're committed to providing our clients with the highest level of service, transparency, and security. And we want to take pride in building long-term relationships based on trust and integrity. So we understand financial markets can be complex and ever-changing, which is why our team of experts is dedicated to providing most up-to-date financial insights and analysis to help our clients make informed decisions and achieve their financial goals. And now we're looking in terms of sort of educational pieces as well. So we thank you for joining today. We look forward to the opportunity to serve as your trusted financial partner. And Maria, I wonder if you could do an introduction to David Gibbs from the CME for us, please.
Sure. Thank you so much, Nick. Let me introduce our speaker. David Gibbs is a futures market professional with over 40 years of industry experience. He has held leadership positions with global future commission merchants and actively traded financial futures, options, and cash market products for both buy-side and sell-side firms. He is an expert in the pricing mechanism for derivatives, including financial futures and their underlying products. David also is a noted teacher of application of futures and options and how they are used successfully by professional traders and managers of risk in today's increasingly unpredictable economic and geopolitical environment. As a leader in developing product content at CME Group, David engages end users of derivative products from asset management, hedge funds, prop trading, and banking communities around the world. I guess we can start our webinar now. If anyone have a question during the session, please post them to the Q&A box. We will have Q&A round at the end with our speaker. So David, stage is yours. We can kick off.
Thank you very much. I trust you can see the screen and also hear me.
Yes, we can.
Excellent. Well, I would like to begin by, first of all, thanking our friends at APM. This is a wonderful invitation, and looking forward to beginning what will be a three-part series on options at CME. Our program over the 3 sessions is meant to be progressive. So for those of you that might have a little understanding about options, the first session is going to be rather basic and might be a bit of a review. But if you're new to listed derivatives or options on listed derivatives, stay tuned, because we're going to begin at the very basic level. And in our second session, move into the pricing mechanics of options as they're expressed at CME Group. And then our third session, which is going to be delightfully done in person during the week of May 8th in Dubai, we'll be going into actual examples of trading strategies using options with myself and my colleague Stuart Jardine, who's going to be giving an excellent in-person presentation on our execution platform, CME Direct, and its options tools driven by Quick Strike. So by all means, stay with us. This is meant to be educational and informative, and we're delighted to be partnering with APM. So I'll begin the first session, which I've titled Foundational Principles, because this is where we have to start in order to understand options, which can be somewhat complicated. You have to understand the fundamentals. So we're going to begin there, and in the second session, move into the pricing mechanics. I do have to say that our sessions together are meant to be educational and informative, and in no way should be construed as offering investment advice, nor making any trading recommendations. You're going to see examples of trades in the presentations, but please don't take that as an indication of investment advice or a recommendation to trade. For those of you that might be familiar with futures, just hang with us for a few minutes. But if you're not new to, or if you're new to futures, I think it would be good to have a level set. All of the options that we're going to be talking about that are traded at CME Group are options on futures. So they're the second derivative in our listing. The first derivative markets at CME are the futures markets, the standardized futures contracts that we trade. So what is a futures contract? Well, let's first begin by what it is not. Futures contracts are not assets. They don't convey any rights of ownership. They don't pay any or accrue any interest, for example. If I'm long an E-mini S&P 500 futures contract, I have, unlike the underlying asset itself, I have no rights of ownership. I'm not getting any dividend income stream. It's strictly a futures contract, which is probably best to be thought of as a price point with an expiration date. Futures contracts are what they say they are. They're contracts. They provide certain rights and obligations to buyers and sellers, and all of those are outlined in the contract's specifications, which you can find on our website under the markets page at cmegroup.com. Now, because futures contracts aren't assets, they don't require full payment of the notional or equity value at the time of execution. So when you engage in futures trading and you're asked to put up collateral or capital to secure your trade, what is it exactly that you're paying for? Well, you're putting up what's known as performance bond. And in the futures industry, that sometimes gets referred to as margin. I want to make sure to those of you that trade equities, for example, or stocks, if you're familiar with buying on margin, that is not the same thing that we're talking about in the futures market. In the securities business, buying on margin means that you still have to legally pay 100% of the equity's share value, but you can borrow, in the US at least, under what's known as Regulation T, up to 50% of that stock's value in the form of a loan from the broker. So that's called buying on margin. And that loan obviously carries with it an interest rate expense. In the futures business, margin refers to this security or performance bond that's required in advance to put up and hold an open position in the futures market. And that's generally a small fraction of the equity value of the underlying risk position, which is why historically, at least at CME Group, our primary form of business has been around risk management for institutional and commercial users who come to us to manage the risk they already have. So these futures contracts are legally binding agreements between the buyer and seller. The terms of that agreement outlined in the contract's specifications. And they're identified by what are called ticker symbols. And each product and each product's expiration is going to have a different ticker symbol. So if you're new to this business, it would be important to understand when you look at your trading screen what it is that you're looking at and what it actually represents. I'm giving you an example here of COMEX Gold, which is a CME Group contract. Our standard gold contract is known by its ticker symbol on Globex, GC, the two letters GC, identifying it as the COMEX Gold futures contract of the standard contract size. Generally, you're going to see that quotation followed by another series of letters and numbers. In this case, I'm using the example of the June expiration, June of 2023. June represented by the letter M and the 3 representing the fourth digit of the calendar year. So the quotation of GCM3 represents a quote of the futures contract of COMEX Gold for June 2023 delivery. Each one of those contracts represents 100 troy ounces of gold, and that underlying product is quoted in dollars and decimals or dimes. If you see a quote, for example, of 2000.0, that represents $2,000.00. Most of the commodity futures that are traded at CME Group, gold included, but and other metals as well, but also crude oil and even our treasury bond contracts are examples of what are known as physically settled or physically delivered commodities. Futures contracts at CME are finally settled one of two ways. Physical settlement, which means at the end of that contract's life cycle, there's actually a physical delivery mechanism built into the contract where the short delivers a warrant, in the case of gold, to the long in exchange for the full payment of the value of that product. This is the point at which the non-asset futures contract is converted into an actual physical asset. So physical delivery defines and imposes the pricing integrity of the futures contract. We also have contracts that are settled through what is known as financial or cash settlement. Equity index futures, short-term interest rates, and a few of our FX contracts are examples of cash-settled contracts. And you can imagine let's just use the S&P 500 futures contracts as an example. It would be nearly impossible, but certainly operationally impossible, to deliver fractional shares of the 505 companies that make up the S&P 500. So it settles to its index value on the final day of trading. And the final settlement value versus the previous day's settlement value, that difference is settled in cash, and the contract then expires. There is no physical transfer. It's simply book entry at the clearinghouse level. The loser pays the winner, the contract expires, and a new contract gets listed further out in the listing cycle. So physical and cash settlement. This is going to come up again as we talk about options as they relate to the underlying futures contracts. Now, the last point about futures is that the price and profit and loss in a long futures position is said to be a linear relationship. In other words, if I'm long a futures contract and the price goes up, I'm going to make money. But if that futures price goes down, I'm going to lose money. And that relationship is pretty much up and down. It's linear. The same is true with a short position. Short position gives that position beneficial activity to downsize price movement. So if I'm short a futures contract and that price goes down, I benefit. But if the price goes up, it's detrimental. It's negative to my P&L. So the relationship is said to be linear. However, options are a different animal. They're the second derivative, and they derive their valuation on the price of the futures contract. But because options, at the point of buying an option, whether it's either a put or a call, and we'll get into those terms in just a minute, buying an option limits the loss to the long position, thereby creating what is known as an asymmetrical risk-reward relationship. And another feature about options that we're going to get into more deeply in the second session is that a lot of the premium that you pay for that option derives its valuation from market volatility. So while options can be both used as directional trades, they can also be employed as means to trade or manage the risk of market volatility. This is an example of a long call position. The call gives the owner the right and the benefit to participating from an upward price movement in the underlying futures market. So when I said it's got a asymmetrical risk-reward relationship, in contrast to a long futures position that was linear, the long call position limits the loss to a downside move to the premium paid for that call option. You still participate theoretically to an unlimited price movement higher, but there's the limitation to the loss as defined by the premium paid for the long call position, hence the idea of it being asymmetrical. Likewise, with a long put position, you still will participate to a movement to the downside in the futures market, but if the market goes higher in the underlying, there's a limit to the loss limited by the premium paid for the long put position. Asymmetrical risk reward. Now, every industry and marketplace has its own language, and options is no different. So now we're going to explore and define the common terms used around options pricing and options trading. So what is an option? Well, at CME, all of the options that we list are options on futures contracts. So the underlying will always be a futures position. That's what we're trading. So if you go all the way or express from a long position, exercise your right to the underlying position, you're not going to get the underlying asset. You're going to get a position in the futures contract. So the option at CME is an option on a futures contract, but it's the right, not the obligation, to buy or sell the underlying before or on an expiration date. There are two types of options: call options and put options, and each offers a different opportunity to the underlying futures market. When we refer to options by type, we can extend that conversation to define them by class, which then classifies their expiration. In this example, let's consider a call with an expiration in December. So its type is a call as opposed to a put. The class refers to its expiration, in this case, December 2021. And then the third identifier is the series, which identifies the actual strike price. So you would refer to the December 21 400 or 4400 call. Tells you the expiration date, tells you the type of option that it is, and the strike price that you're referring to. This is an example of a tool that's available at CME on our website for free. It's powered by QuickStrike, and it's called the Open Interest Heat Map, and it shows the open interest or open options positions. And in this example, these are E-mini S&P futures options. But what I wanted to point out with the screenshot was the examples of, you can see at the top under ESU1, that is the futures contract. This is obviously an old picture, because that would be the September 2021 E-mini futures contract, on which underneath that shows the expirations of a bunch of options that are listed that have that futures contract as its underlying. Note, for example, ESU1 refers to the quarterly expiration of the September 2021 E-mini options that have 49 days until delivery. So it's showing you the various expirations available under that futures contract and the number of days until expiration. It also points out the two columns, the calls and the puts, and then on the left-hand column, the various strikes. And in the middle, in those little boxes, in many cases highlighted in the color green, you're seeing the number of contracts open at that expiration, in that put or call, at that strike. This can be relatively important information for traders. They want to know where there are large pockets of open interest in various options, because as the futures market approaches that strike price, it could create an enormous amount of what is known as delta hedging around a large open interest in an underlying options position. We'll get into more of those details in the second and third session. Every option has an expiration date, and that's its last trading day, but it also is the last day that the option can be exercised. And on that last day, if the option expires, that means that the option owner no longer has any optionality, and the option seller no longer has any obligation. Expiration dates are very important, and depending on the type of option, it can be either the only day that exercise and assignment can take place, or in the case of American options, it can take place earlier. More on that in a few minutes. Now, at CME, we list a lot of option expirations and a lot of different strikes. Not all of the options expirations are going to be coinciding with the underlying futures contract, and in fact, most of them do not. And in some cases where it is a physically delivered futures contract, the options expire in many cases much, much earlier than the last trading day of the futures contract. I'll explain why that is in the next few minutes. Let's take a look at an example. Our COMEX gold contract, as I previously mentioned, identified by its ticker, GCM3, is the June expiration of 2023 for the standard gold futures contract. It has a last trading day for the June contract on the 28th of June. However, its first delivery day is the 1st of June. In fact, most of the remaining open interest in the June contract will more than likely be delivered in that first week of June. Well, this poses a bit of a challenge for the options on that contract, because you can imagine, now think about this with me for a minute, if you own the option on the June futures contract and it doesn't have any open interest because it's all been delivered on the 1st of June, the option would be worthless. So in order for the option to have any kind of valuation, it's going to have to expire before the first delivery day of a physically settled futures contract. So you'll notice that the June options on gold, and this is identified by the letters OGM3, or the gold standard gold options for June delivery, for June expiration actually expire the 25th of May. And that's so that there would be all the open interest in the June futures contract on which is its underlying would be available if the owners of those options wanted to exercise their rights. That's why with a physically settled futures contract, the options are going to expire prior to the first delivery day of the futures contract to ensure that there's open interest for the options buyers to be able to exercise to. Now, with a cash settled contract, it's less sensitive because there's no worry about an early delivery or a delivery at all. They can tend to maintain expirations like in our S&P and our equity index contracts the same day as the futures expiration. It simply exercises into a futures contract that's immediately settled to cash. Strike price is sometimes referred to as the exercise price, but I'm going to be referring in my conversations with you, always referring to it as strike price. And that's the identifier of the underlying futures contract level to which the option buyer and seller are targeting. So for example, using the June 2023 E-mini S&P 500 futures, if it's a 4150 call, that represents the strike price, 4150, and that corresponds to a price in the June futures contract of 4150.00 index points. So the buyer of a June S&P E-mini 500 4150 call, if they exercised their rights, would receive a long position in the June 2023 June futures contract at a price of 4150 even. The short option holder, the short call holder in that case, would be assigned the corresponding short position in the futures contract, regardless of where the underlying futures market is. So again, the long position exercises their rights to receive the underlying futures position, and the short position is obligated to create the opposing side. Because remember, in the futures market, there's always a buyer and a seller. There's always a long and a short. Another term that's used in options trading refers to what is known as moneyness. At the money, in the money, out the money. What does this mean? An at the money option simply means that its strike price, or the market is the futures market, the underlying market is at the strike price of that option. So for example, in that previous slide, a 4150 call would be considered at the money if the underlying futures contract was around 4150 even in index points. In the money means that for calls means that the underlying futures market is above the strike price of the call, meaning that it's got real value. A put becomes in the money if the futures price is below the strike price. And then correspondingly, an out of the money position would refer to in calls a futures price that is below the index value, and a put would be above, the strike price would be above the index value. These become very important when we talk about the location of the futures relative to the strike, or the strike relative to the futures price. I briefly alluded to these two terms, exercise and assignment. Exercise is the process by which the options buyer, the long position, whether it's a put or a call, exercises their right to the underlying futures position. If the call buyer exercises their right, it's to a long futures position. If the put owner exercises their rights, it's to a short underlying futures position. And then the opposite side of that trade is handled by the assignment to the options seller. The short option position is responsible for the obligation to create the opposite and opposing position to the options buyer. And that doesn't make any difference where the underlying market is. That's why outright short options positions are considered to be so dangerous, is that they theoretically have unlimited risk in terms of price action. There's also a third risk called pin risk, and that refers to an option at the moment of expiration that might be hovering at or around. The futures market might be very close to the strike, but not necessarily automatically at the money. The seller may not know whether they're going to get assigned or not. That's known as pin risk. If you want to avoid pin risk, the only way to avoid it is to get out of the position prior to expiration, or to roll that position forward into another futures options position. Premium is the price that's paid for the option. It's what the buyer pays and the seller receives for these rights and obligations. The premium is driven by market conditions, and we're going to talk in greater detail about that in the second session when we get into pricing mechanics. But there's a lot of variables, as you're going to learn, that go into determining the premium of an option. So I'll defer this part of the conversation until the next session. The underlying, when we talk about the underlying product at CME options, will always be a futures contract. So in other words, I'll use gold as an example. If you exercise your rights in a gold option at CME, the underlying position will be a COMEX futures position, not the underlying physical gold. If you're trading E-mini S&P options, the underlying position will be an E-mini futures position, not an underlying position in the spot index. That's a very important feature to be mindful of. Two other terms that might come to mind would be the types or styles of options, American style versus European style. A European style option simply means that the owners can only exercise their rights at the date of expiration. An American style option gives the owner the right to exercise that anytime prior to expiration. So you can imagine knowing this is important in the pricing mechanics of the premium, because an American style option gives you the right to exercise before expiration, therefore potentially giving a variable in the pricing mechanics. Europeans options are easier to price because the exercise is known. It can only be done at expiration date. Volatility, we mentioned at the outset, is an important part of options calculations, but how we refer to it can differ. Volatility measures the rate and the magnitude of the change in the price of the underlying. So again, we're talking about futures prices here. High levels of volatility, greater volatility or rising volatility tend to add value to the options premium. Low levels of volatility or falling volatility tend to subtract or depress an options premium. We refer to volatility generally in two fashions. Historical volatility is sometimes referred to as realized or statistical or actual volatility because it's based on settlement prices and looks backward. We can look at the actual prices of the options. We can look at the actual price of the underlying and calculate an actual volatility. But the one that's most commonly expressed during market trading hours, when the markets are live and fluctuating, is what's known as implied volatility. This is the volatility that you determine based on the premium of the various options versus the underlying futures market. That's why it's referred to as implied. You're not using volatility to arrive at the premium. You're using the premium to arrive at the volatility. Now, that doesn't mean you don't have, you can use the implied volatility to arrive at a theoretical premium, but the two are going to be very fluid depending on what's going on in the marketplace. This we're also going to get into greater detail in the second session. Then lastly, I want to just reaffirm this notion of asymmetrical risk reward with options. Options buyers, because they are paying the premium, have limited risk to the premium paid and an open-ended or theoretically unlimited reward if the market moves in the direction of their position. In other words, the call buyer to an upward priceward movement, the put buyer to a downward price movement. The options seller has open-ended or theoretically unlimited risk, but limited reward to the premium they receive at the point of initial transaction. No matter where the market goes, that premium that they receive is not going to increase to their benefit. It will only get worse if the market moves against them. So open-ended risk to the options seller, limited reward, the flip side for the options buyer. Now, this can also be expressed in terms of spreads, and we're going to talk a little bit more about that when we get to the third session. Let's dive a little more deeply now into this risk-reward structure as it's expressed with different types of options. Let's first consider a call option position. Assume that and I'm going to use E-mini S&Ps as a working example here because I think most of us understand how a stock index works. Assume the E-mini S&Ps for June 2023, the futures contract, are at 41.5350. The buyer of a 41.50 May 2023 call pays 91 index points for that call option. Their maximum risk, therefore, is the 91 index points. And since each index point is worth $50, their maximum risk is $4,555. That's the most this trade can lose if the market goes down. However, if the market does trade higher, they will participate in the upward price movement. Theoretically, is unlimited based on the time left in the option. But in order to begin to participate in that wonderful positive P&L, they first have to get above the break-even point. And if you look at this, I'm not sure if my cursor is visible to you, but if the strike price and the premium is here, and the strike price is here, they don't begin to profit until you've covered the point spread or the break-even point of the 91 index points. So example, in order to begin to make money in the long call position, the futures contract has to trade above 42.41 in the index in the futures contract. So yes, you're participating in an upside move, but not until you recover the cost of the premium paid. Now let's consider the profit loss on a long put position. Same market, same price of the underlying, 41.50 and a half, but this time buying a May 2023 41.50 put and paying 80 and a half index points. 80.5 index points means that your cash outlay is $4,025. That's the maximum this position can lose if the market trades higher. And just like the call position, if the market trades, in this case, trades lower, the long put position will participate favorably in that price action, but only after they recover the premium paid. So in this case, it is the premium subtracted from the strike price to arrive at the break-even point. The market in the E-mini June futures will have to trade below 40.6950 before the long put position actually begins to benefit beyond the premium paid. So again, you can see the asymmetrical risk reward, limited risk, unlimited reward to an outright long put or call position, depending on which way the market moves. The buyers always pay the premium, and they pay the full amount upon purchase. That's all they can risk, and because that's all they can lose, there's no additional margin required or no additional collateral required for that open position at CME. However, option sellers, because they're subject to that theoretical unlimited risk, the premium must stay within their trading account, and additionally, they may be required to put up more margin or more collateral to secure that open position against adverse price moves. So the buyers pay the full amount at point of execution and no more. The sellers may be required to, they're required to keep the premium in account, but also maybe having to add additional funds to keep that position open. The reason these products are so successful in terms of their growth, not just at CME, but worldwide on every exchange, options are the fastest growing product on basically every futures exchange in the world. And it's because of this advantages of the asymmetrical risk reward, and also the fact that you can use them to target volatility. It allows traders and risk managers to put on positions that can be more finely tuned to their what they want to hedge or risk, or the risk they want to assume. Especially since the listing, and we've been doing this at CME the last several years, additional short-dated options expirations. This gives traders and risk managers a lot of latitude to pinpoint exact dates. Could be important because of an economic release, a Fed meeting, a non-farm payroll number, a crude oil reserve, an OPEC meeting, something like that. It could also be more targeted to the risk manager's risk position. They may have a date that doesn't align with the old quarterly dates, and they want to only cover the risk up to that date, and they don't want to pay more premium than they have to. So the more we list the shorter dated expirations, the greater the participation in the marketplace, because end users can target and tailor risk positions using these products. Another concept we need to address is this thing called intrinsic and the value of the options premium. Intrinsic value refers to the value of the option in its premium related to the strike price in the underlying futures market. So the premium is made up of two components, intrinsic value and time value. Intrinsic value for a call is simply the market price minus the strike price. So if it's in the money, if the market is above the strike price, it's going to have intrinsic value. For a put, it'll be the opposite. In order to have intrinsic value, it'll be the market being below the strike price. To make it in the money, the market will be below the strike price. Time value just simply reflects the difference in the premium minus the intrinsic value. So let's consider some examples. This is the intrinsic value of a call. Intrinsic value and time value make up the premium. If we consider the June E-mini futures contract at 41.63 3/4 index points and a 41.70 call with a premium of 102.75, this option has zero intrinsic value because its strike price is above the price of the futures market. It's out of the money. So why does it have 102.75 index value points of premium? It's all time value. Notice that there's 63 days until delivery. A lot can happen in 63 days, and it's very close to being at the money. So the market is giving it value for the time value that's left in it, but no intrinsic value. If you consider a put option at the same time, same futures price, 41.63 3/4, same strike price, 41.70, but because it's a put and the strike price is above the market price, it is in the money. Therefore, it does have intrinsic value. How much? The strike price subtracting the market price tells you that there's 6.25 index points of intrinsic value. The rest of it, 102.75, is time value. Now notice, the time value in the put option is the same in the time value of the out-of-the-money call option. This is known as what's known as put-call parity. And we're going to talk about that in greater detail in tomorrow in the second session. But this is telling you the pricing mechanics and the pricing mechanics of the options relative to the futures price are keeping the puts and call premiums in alignment with one another. Put call parity, if it were to get out of alignment, would provide an arbitrageur the ability to create a synthetic futures position using options against the actual futures position and are about virtually a risk-free trade. So these premiums between puts and calls are very much in alignment based on the other inputs that drive them, but in relationship to one another through this mechanism identified as put-call parity. I'm going to stop our session at this point to take a breath and also ask you if you have any questions of what we've covered so far.
Thank you so much, David. Just a reminder to all participants, if you have any questions, just drop them in QA or chat box. We received one question at the moment. Why it is important to consider interest rates when determining the price of options?
That's a good question, and I'm not going to be covering that in the second session, but it's another input in the premium, and it has to do with the time value of money. Just like in the futures markets, in financial futures, we refer to that as the cost of carry, or what's the financial impact of a risk-free rate relative to a futures price. It's also covered in physical commodities. What is my storage costs, my transportation costs, and the cost of money, the opportunity cost of another asset that produces some sort of an income. So in options, higher interest rates will have an impact on premiums. Lower interest rates will tend to reduce the premiums because there's less time value of the opportunity cost of a lower risk interest-bearing investment. So as interest rates move higher, premiums will have to reflect to a small degree the value of the opportunity cost of a risk-free rate. Now, in the U.S., we would be looking at, say, the 3-month Treasury bill, a risk-free rate of roughly 5%, as an input in premium calculations. So, yes, short-term interest rates, depending on the market and depending on the currency, can have an impact to a small degree on the pricing of the premium. Thank you for the question.
Thank you. We got a few more questions. If the market is more volatile, then should we trade in future contracts or in option contracts, which is preferably as a risk factor?
Well, as I said in the beginning, I'm not allowed to give any trading advice, but I would say highly volatile markets will increase the premium values of most options. So depending on your risk tolerance, there could be, and I'm stressing here that this is not a trading advice, but there could be opportunities in options that might be because of the inclusion of volatility in the premiums. If you believe that the volatility is a short-lived thing, there could be opportunities to express that point of view just in volatility by trading options. If you felt that volatility was extremely low and was going to expand or increase, there could be ways of expressing that in options that you wouldn't be able to express in futures. Because remember, the volatility that's being expressed in CME's options is the volatility of the futures price. So there's, to my mind, there's no way to express a strictly volatility expression in futures. You're either long or you're short. Now, the volatility will contribute to the magnitude and the speed of the price of that futures position, but it's not necessarily going to change the pricing other than as it's moving from left to right on a trading chart. But volatility as an input in options also allows you to isolate that through various spread tactics to be able to capture rising and falling volatility either profitably or detrimentally, depending on how you're positioned. So the shorter answer to your question is, I can't give you a point of view about it, but the longer dated study or answer we're going to cover in the second session. And the third session, particularly when we talk about trading strategies around volatility. Thank you for the question.
Thank you. Questions. CME options, are they American or European?
Both. Depending on the product, they could be American or European. And in some of our products, you've got to be very careful because we offer both. So again, this is where you need to do your own homework and go to CME.com, identify the product, look at the contract specifications for the options that you're interested in, and it will tell you in the contract specifications whether they're American or European. But we do have products that have both American and European options offered. So it's very, very important to understand which one you're dealing with in advance so that you're not caught off sides. Thank you.
Thank you. Who are more successful and make profit, option buyer or seller?
Again, that's depends on the market, doesn't it? Historically, there have been some market pundits that have said, "Oh, why would anybody ever pay for an option? Because it's got time decay and it's and so forth." But writing options or selling options can be a very dangerous proposition. It can also be a very profitable proposition. So it all depends on market conditions, the way you're positioned, whether you're spread against something else. The wonderful thing about the options business, particularly at CME, because we have so many different products and we have so many expiration dates, and both in futures and in options, you've got opportunities to express virtually an unlimited view about what you think is going to happen in the underlying market. So depending on whether or not you get all of those inputs lined up correctly, options trading can be hugely profitable. However, it can also be negative. It doesn't make any difference if you get the direction of the market right if it happens the day after your options expire. So depending on how you use the products will directly affect the results. The reason the risk management community likes options is because they can identify their hedge risk at the point of execution. In other words, if I'm using options, long options positions to express or put on a hedge against an adverse price move, I know the cost of my insurance before I actually enter the trade. Whereas with a futures contract as a hedge, my risk is theoretically open-ended. So this is, again, that asymmetrical risk reward example in options makes them very, very beneficial to risk managers as well as traders. Thank you.
Thank you. How can you use options to manage risk in your portfolio?
We're going to cover that in the third session, but the short answer would be they can be used because of, and we'll cover this when we get into pricing mechanics as well. And it gets into the calculations of the delta, a delta hedge, and being in and out of the money relative to where the underlying market is. I think options can be very, very effectively used as adverse price hedges because they will, let's, for example, consider a stock portfolio. If I want, and I've got an index portfolio to the S&P, I want protection from a downside move in the index price, in this case expressed by the E-mini futures contracts. If I buy a deep out of the money put, the premium, because it's so far out of the money, is going to be very, very small. But I'm buying it so far out of the money because it's a certain percentage number away from where the market is now, a severe adverse price move. By buying that out of the money put, I'm not going to pay very much. But if the market were to sell off dramatically, my hedge ratio calculated before the big move down is based on a delta that's small, but is increasing at an accelerating rate as the market goes down. That's known as, and I'm going to cover this in the next session, but that's known as positive convexity. And that's everything to a risk manager. What you want is price protection to an adverse price move, but what you want from the option and what you're going to get from an option that you're not going to get in a futures position is positive convexity to that downside move. We're going to cover this in greater detail in the third session when we all meet together in Dubai in a couple of weeks. Thank you for that question.
Thank you so much, David. You can do one more question. Which are the most active option volume-wise?
Again, I'm going to say that depends on market conditions. Probably the biggest franchise in options that we have at CME is on short-term interest rates, SOFR options. They're huge. There's multi-millions of open positions representing billions and billions of dollars of underlying market risk. Our options complex on our equity index futures is also very, very large and growing. But every one of our asset classes where we have benchmark futures products have very active options against them. So this includes agricultural commodities. It includes base and precious metals. It includes the energy complex in terms of crude oil and natural gas. But it also includes foreign exchange and treasury bonds and other equity index futures contracts. So market conditions drive trading activity. When there's increased volatility and increased trading activity, the options increase at an accelerating rate. So it would be dependent on market conditions.
Thank you, David. Nick, do you want to ask anything on your side?
I was just going to say, David, I'm looking at a lot of the questions that have come in, and there are many more questions which we won't have time to answer today. But I'm pretty confident that session 2 and 3 will actually answer most of the questions that have been actually put on the table today. So it's really good to see those questions, because I think by attending sessions 2 and in the in-person seminar in a couple of weeks' time as well, that you will have most of these covered. And you know, as somebody who's grown up in the options industry myself, you know, it's kind of to be re-educated and see what the markets are doing today. I can't wait for the next 2 sessions, and I hope everybody else joins, and if possible can join us at the in-person session, which is if you don't know the details, let us know and we will get the details to you. I think somebody was actually also asking just for a quick link to the sort of the was it the quick map or heat map?
Yes.
If you can,
we've got several tools. All you need to do is go to cmegroup.com and under the markets tab at the top, go down to options, and that'll take you to a different landing page. You'll see all kinds of tools that are available, free to use at your own speed, at the comfort of your own computer. Heat map is one of them. It'll be under volume and open interest tools. And then you can look at the heat map for any of our active options markets based on the product, expiration, and then actually, if it's a big offering, like say in SOFR options, you can move the bar up and down to various strikes and different expirations. The problem now has become, because we've listed so many expirations, getting them all to fit on a screen at one time is near impossible. But what's brilliant about the heat map is it shows you where those pockets of open interest lie. And I know from a technical trading standpoint, this is a very, very important information. As we approach an options strike price, if there's a large pool of open interest there, you've got some portion of that open interest that are known as the traders that are trading their delta. They want to remain neutral to the market. So if the market is going down and approaching a big pocket of what was previously out of the money puts, you can bet there's going to be some short put owners, short put positions that are going to be selling futures to hedge their open exposure to that strike price, and vice versa for an out of the money call if the market's trading higher. So this information is vitally important. and it's available on a delayed basis for free on the website. There's also some, other tools that are available that you can access through that same thing, like pricing sheets. There's an options premium calculator where you plug in the futures price and you put in the strike price and the expiration. It'll give you the theoretical value of what the premium should be under certain inputs. All of these things are meant to be educational. And this is where you can begin to take the teaching that you're getting today. The learning takes place later. That you're going to get on your own as you begin to deal with different markets and different movements and begin to see exactly what we're going to be talking about in our 3-session program, how the dynamic nature of options relative to futures plays out for various strategies. So by all means, go to the website and see what you can find there under options that's available for your use. And again, come back and join us in our next session as we get into the actual pricing mechanics, or what we would call the Greeks in options trading, in greater detail. That will hopefully give you a little further insight into the nature of these products. And then, of course, our 3rd session, which will be hosted in person by APM in Dubai in a few weeks. We would love to see you all there, where you'll get a real taste of these markets under live conditions as we explore various strategies around directional trades, volatility trades, trades to benefit that could be used for adverse price moves, etc. So I want to take just the last few seconds here and thank our hosts, APM, for having us today. We appreciate their partnership with us, and we look forward to our further sessions together. Nick, thank you very much for having me today, and I'm looking forward to our next session.
Absolute pleasure, David. Thank you so much.
Thank you all, and best of luck to all of you.
Thank you so much, David. Thank you, everyone, for joining us and see your questions.